While the retail market is obsessing over the daily price charts, the smart money is watching something entirely different. There is a massive divergence forming between the price of Ethereum and the underlying security of the network that most people are completely ignoring. We are seeing on-chain data suggesting that institutional entities are quietly positioning themselves for a liquidity crisis that will hit the supply side by late 2026. If you are holding Ethereum right now and you think the standard 4-year cycle is the only thing that matters, you are exposing your portfolio to unnecessary risk. The reality is that the upcoming Glamsterdam upgrade is not just a technical patch, but a fundamental restructuring of how value moves through the entire crypto ecosystem. In the next few minutes, I'm going to break down the specific architectural changes coming in 2026 and prove why the current market price is failing to price in a massive supply shock. I will walk you through the exact data points regarding validator withdrawals and Layer 2 settlement times that suggest we are entering a new era of scarcity. Do not let the current low volatility fool you into complacency. We are standing on the edge of a structural shift that will separate the informed investors from the liquidity exit liquidity. Let us get into the weeds. To understand the magnitude of the Glamsterdam upgrade, we first need to look at the current state of the Ethereum execution layer. Right now, we are seeing a fragmentation of liquidity across dozens of Layer 2 networks. While this has lowered fees for the average user, it has created a fragmented landscape that makes institutional settlement difficult. Big banks and large asset managers do not want to bridge assets across 5 different optimistic rollups just to find yield. This is where the Glamsterdam upgrade changes the game completely. Scheduled for implementation in 2026, this upgrade focuses on atomic composability between these fragmented layers. The technical documentation suggests that Glamsterdam will introduce a new form of state expiry that drastically reduces the hardware requirements for nodes. Here is why this matters. When you lower the barrier to entry for running a node, you decentralize the network to a level that makes it legally compliant for strict sovereign wealth funds. We are already seeing the 30-day moving average for validator activation queues ticking upward. This metric has not been this aggressive since the months leading up to the merge in 2022. It tells us that large capital allocators are locking up Ethereum now, anticipating that the yield rewards post-upgrade will be significantly higher. The market generally assumes that staking rewards will compress as more people stake. However, the Glamsterdam proposal includes a dynamic adjustment to the issuance curve that most analysts have overlooked. If the network activity on Layer 2 solutions increases by just 20%, the burn rate on the base layer accelerates beyond the issuance rate. We are looking at a potential deflationary spiral that is 3 times more aggressive than what we saw in late 2021. The math is simple, but the implications are profound. If you have 2% of the supply disappearing annually while institutional demand ramps up, the price cannot remain suppressed forever. This is the kind of asymmetry that creates generational wealth, provided you are positioned correctly before the headlines break. If this data is helping you stay ahead of the crowd, feel free to join our inner circle by subscribing to the channel for more deep dives. Now, let us look at the concept of statelessness, which is the core pillar of the Glamsterdam hard fork. Statelessness allows the network to verify blocks without storing the entire history of the blockchain. For a retail investor, this sounds like technical jargon that does not impact the price. That is a mistake. Statelessness is the feature that allows Ethereum to scale to millions of transactions per second without sacrificing security. Currently, the data shows that the size of the Ethereum state is growing at a rate that is unsustainable for consumer hardware. If this trend were to continue without Glamsterdam, the network would eventually become centralized around a few massive data centers. That outcome would destroy the value proposition of the asset as a censorship-resistant store of value. By solving this state bloat, Ethereum secures its position not just as a computer, but as a settlement layer for the global financial system. We are seeing early testnet data indicating that block verification times could drop by over 40%. This speed increase is exactly what high-frequency trading firms have been waiting for. They need assurance that their transactions will settle instantly and with finality. Once Glamsterdam goes live in 2026, the argument for alternative Layer 1 blockchains becomes much weaker. We are already seeing a rotation of capital out of so-called Ethereum killers and back into the Ethereum ecosystem. The dominance chart for Ethereum excluding stablecoins has broken a multi-year downtrend. This is a signal that the market is beginning to sniff out the consolidation of power. The reality is that liquidity follows security and reliability. When you combine the security of the base layer with the speed provided by the new upgrade, you create a black hole for liquidity. I want to highlight a specific metric known as the exchange reserve ratio. This measures the amount of Ethereum sitting on exchanges ready to be sold. It has hit a 5-year low this month. Typically, when exchange reserves drop this low, it precedes a violent move to the upside because there is simply no supply to meet demand. Now imagine hitting that supply crunch at the exact moment the Glamsterdam upgrade creates a hype cycle in the media. The fear of missing out will not just be retail investors buying $500 worth on an app. It will be hedge funds allocating $500 million to secure a position in the staking yield. This is the difference between a normal bull market and a super cycle. The structural mechanics of the market are being rewired in favor of the holder. However, there is a risk vector that we must discuss to remain objective. The transition to the Glamsterdam protocol involves significant code complexity. There is always a non-zero chance of a bug or a delay in the rollout. We saw similar delays during the transition to proof of stake. If the developers announce a delay in late 2025, we could see a sharp correction in price as speculative leverage gets flushed out. That is why you must monitor the developer calls and the testnet participation rates. Currently, the developer activity on the core protocol repositories is at an all-time high. This suggests that the timeline for 2026 is robust and on track. If you appreciate this level of unbiased analysis that focuses on risks as well as rewards, consider hitting the like button to help this video reach more serious investors. Let us pivot to the derivative markets. The open interest on long-dated Ethereum options for December 2026 is already starting to build. Sophisticated traders are buying call options with strike prices that seem ridiculous to the average observer. They are betting on the successful implementation of Glamsterdam. When you see option flow this far out in time, it is usually a sign that insiders know something the public does not. They are locking in their entry prices now because they understand the mechanics of the burn. The issuance of new Ethereum is projected to drop effectively to zero or become net negative during periods of high congestion. This creates a scenario where the only way to acquire meaningful amounts of Ethereum is to buy it from someone else at a much higher price. Miners are gone, so there is no constant sell pressure from electricity costs. Stakers are the new producers, and they have very little incentive to sell when the yield is rising. This creates a supply shock that is mathematically guaranteed if the network usage stays constant. But we know network usage is not staying constant. It is growing exponentially. The tokenization of real-world assets is the other catalyst that Glamsterdam enables. To tokenize stocks, bonds, and real estate on a blockchain, you need absolute certainty of finality. You cannot have a blockchain that reorganizes blocks or has high latency. The upgrades coming in 2026 specifically address the finality gadgets in the consensus mechanism. This will reduce the time to finality from roughly 13 minutes down to a single slot, which is 12 seconds. This is the holy grail for traditional finance integration. Once finality is instant, the floodgates for trillions of dollars of traditional assets can open. We are already seeing pilot programs from major banks testing these tokenized assets on private forks of Ethereum. They are preparing for the mainnet upgrade just like we are. So, how should you position yourself based on this information? First, you need to stop looking at the daily volatility as a signal of health. The price action today is noise. The protocol development is the signal. Second, you must understand that your time horizon needs to align with the 2026 roadmap. This is not a trade for the next 2 weeks. This is a position for the next 2 to 3 years. The accumulation phase is happening right now, while the general public is distracted by meme coins and artificial intelligence tokens. By the time the mainstream media starts talking about Glamsterdam, the easy money will have already been made. The smart play is to front-run the narrative before it becomes a headline. You want to be the one selling into the liquidity of the latecomers, not the one buying from the insiders. The playbook is clear. Monitor the exchange outflows. Watch the validator queue. Keep an eye on the successful deployment of the testnets leading up to 2026. If these 3 metrics remain bullish, then any dip in price is simply a deviation from the fair value. The transition to the Glamsterdam era represents the maturity of Ethereum from a speculative asset to a foundational layer of the global economy. Those who understand the technicals will be rewarded. Those who ignore them will be left wondering why the market moved without them. Do not let the complexity of the upgrade scare you away from the opportunity it presents. The data is there for anyone willing to look for it. Stay focused on the fundamentals and ignore the noise. As always, please remember that I am a market strategist and analyst, not a financial advisor. All financial decisions should be based on your own research and risk tolerance. The markets are volatile, and past performance is not indicative of future results. Ensure you consult with a certified professional before making any significant investment decisions. Stay sharp and watch the chain.